The market is at a clear inflection point. You've got powerful Q4 seasonality clashing with some really weak internal data. Here's the tactical plan for the next 1 to 2 weeks.
So this is the central question, right? Can these strong seasonal tailwinds actually power through the market's deteriorating health? Let's dig into the data on both sides.
All right, let's break it down. The market is basically being pulled in two opposite directions. The bulls are hanging their hats on history and earnings. The bears, well, they're pointing to a bunch of technical warnings that are getting pretty hard to ignore. And the contrast here is pretty stark. On one hand, you have an 86% earnings beat rate, and we're entering the strongest seasonal quarter of the year. That's the bull case. But on the other side, we've got a cluster of Hindenburg Omens signals, which basically scream market divergence, and active managers are leveraged over 100% long. That's a huge contrarian flag that suggests all the buyers might already be in.
Okay, so with that conflict laid out, let's look at what's coming up. There are a few key events that are likely going to force the market's hand one way or the other.
The big one, of course, is the upcoming jobs report. Any surprises there will move everything. Then, in the tech space, you've got earnings from Palantir and AMD, which will be a real test for that sector's leadership. All while this is happening, the VIX is starting to creep up from its lows, and the US dollar index keeps getting stronger, which is almost always a headwind for stocks. You know, when you look under the hood, the internals really do suggest this market is running on fumes. The leadership is just dangerously narrow. We're talking about a handful of megacaps holding up the indexes while the average stock is actually falling.
So let's talk levels. 6750 on the S&P 500. This is the critical support. It's the line in the sand, right around that 20-day moving average. For any bull case to stay alive, this level absolutely has to hold.
And on the flip side, you've got 6912. This is the key resistance, the ceiling that has stopped every single rally we've seen recently. If the market fails to break through here again, it just confirms all the underlying weakness we're seeing in the data.
And this table right here just shows you that divergence perfectly. All the leadership is crowded into a few names like NVDA and Amazon. Meanwhile, the really important cyclical sectors, your regional banks, your financials, your industrials, they're all starting to roll over. This is not what a healthy market looks like, period.
This content is for educational purposes only. Do your own research. This is not financial advice.
All right, so given all this data, we can start to build a practical framework. Let's walk through the most likely scenarios and how to think about positioning for them.
My base case, and I'm putting about a 60% probability on it, is that we just keep chopping around between our key levels. 6750 on the low end, 6912 on the high end. Now the bull case gets triggered by a clean break above 6912. And the bear case, that gets triggered if we get a sustained break below 6750. The triggers here are very clear.
So, the bull thesis is simple. It's that seasonality and earnings are just too strong to bet against. In this world, the market just shrugs off the bad news. Every dip gets bought, and we finally punch through 6912 to rally into the end of the year. The invalidation is crystal clear, a break of 6750.
The bear thesis, on the other hand, says the gravity is going to win. The weak internals and all those technical warnings will finally matter. That leads to another rejection at 6912 and an eventual break of 6750. And this thesis is wrong if and only if we see broad participation return to the market, not just a few tech giants doing the lifting. Okay, last part. Let's translate this analysis into a few specific, risk-defined strategies that line up with these potential outcomes.
All right, first, a hedge. If you want to protect against that bear case for the next week or two, a put-debit spread on SPY makes a lot of sense. It's a define this way to profit from a move down. The target is that 6750 support level, and your invalidation is a clean break above resistance at 6912.
Now, what if you want a position for a rotation? If money flows out of tech, a sector like energy could catch a bid. A call debit spread on XLE is a low-premium, defined-risk way to bet on new highs. You're basically playing for a move into a sector that's showing some relative strength.
And for a pure volatility play, let's look at Palantir's earnings. A long straddle or strangle is the go-to structure here. You're not betting on direction, you're just betting on a big move, up or down. But be warned, the main risk here is implied volatility crush, which can kill your premium even if you get the direction right. Because of that, your position size has to be small.
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.
So we end up right back where we started. We have exhausted buyers, leveraged managers, and a handful of stocks holding the whole thing up. The data is screaming caution. The question you have to ask yourself is the raw power of Q4 seasonality enough to defy all of that and fuel one last push higher?